data from the Banco Central showed FDI inflows dropped 12% year on year to $523 million. This was also 17% lower month on month from August this year. The central bank said the return of stricter restrictions under a modified enhanced community quarantine or MECQ in Metro Manila and surrounding areas in the first half of August may have dampened investor sentiment on prospects of the country's reopening. From January to September, FDIs dropped nearly 9% to $4.8 billion. The BSP said the decline in inflows reflected the worldwide cautious investment climate following the continued effects of the COVID-19 pandemic on the global outlook. All right, and kicking off markets with some offshore optimism, and in the midst of mobility restrictions, the biggest tech IPO of the year happens to be travel related. Tell us more about that.
Exactly, Jess. So this is some exciting news. It's not often that we look at U.S. stocks for that matter, but there is one big deal here. That's Airbnb, our beloved Airbnb. Most of us have used this sort of platform, and they were really in the news during this COVID-19 pandemic. They laid off thousands of employees, especially as these mobility restrictions were in place all over the world. And now they have just done an IPO that was yesterday. They had priced this IPO at $68 ahead of the opening, and then it opened at $146. It's more than double. And take a look at how it closed trading yesterday. That's $144.71. That's 113% higher than what they were hoping to even raise in their IPO, diba? So that brings their valuation to about $100 billion. That's one of the biggest first day rallies on record. And what's really interesting about this company is that they were already having plans naman to do an IPO, but that was of course put on hold in March when all of these issues on global travel came to a halt. In April, the bookings of the rooms had plunged by 72%, and they had to refund more than $1 billion in cancellation fees. So this listing comes 10 months just after that. And then it actually soared double the amount, diba? So it's quite a big deal, especially after they did this IPO after another company, which is also related to travel industry over the US. It's called DoorDash, also soared in the public debut. Now, what are analysts saying? They're saying that retail investors are embracing these companies, which are poised to thrive as, of course, these vaccines promising to at least loosen the pandemic restrictions. This, I want to cite one analyst here. He said, "We've seen how resilient this business model is, and we've seen the companies stare into the abyss of a pandemic that shut down global travel and figure their way out of it." I mean, what a nice statement to make, diba, Jess? And this is what people have been calling the pandemic crush. It's pretty cute. Of course, it's seen, a bounce back. And what has brought about this bounce back? They've been saying that Airbnb has managed during the pandemic to put in place, safety standards, and also just cater to those working from home that wanted to book far away from the big cities, for example. So they managed to really stage a comeback. So pretty exciting times here, and let's see whether this optimism for the travel industry in this one player spills over towards the rest of the cyclical sectors. So let's take a step back and just take a quick peek at how markets have opened in the rest of Asia. You can see the Nasdaq up by 0.5%. Tech shares being affected here, probably also on the back of that optimism in terms of tech travel. But you'll see Asia a bit on the back foot, especially for the Nikkei 225. That's down by 0.7% as of 9:15 this morning. Over in Hong Kong, markets are still close and percolating, but you can see a bit of a mixed picture here. Taiwan, for instance, is in the green. That's up by 0.5%. Korea's Kospi and Kosdaq also enjoying some gains here. Now, let's take a look at our own index. We saw a bit of a bounce back yesterday, and this according to PhilStocks. That happened as, of course, the Congress finally ratified the 2021 budget. We're just waiting for the signature of President Duterte. And this is what PhilStocks is saying caused the market to end higher. Yesterday, we were up by 0.7% already, and we seem to be going on that same path. We're close to closing in on 1% gain at 7224.17. And this, according to Terms and Securities, market participants are optimistic, especially over the government's push to further reopen the economy. We had some strong turnovers here. That was around 7.6 billion pesos worth in trades. Now, another one that is generally optimistic, at least for 2021, is Sun Life. They're saying that we might be seeing the index move to 8,000 by the end of 2021. Now, this, of course, is a target that indicates a 12% gain from what we are seeing as yesterday's close. And that's a 20 times forward PE valuation, which is still quite expensive according to them, but would be justified if the average growth in earnings is around 45%. This is according to Mike Enriquez, who is the Chief Investment Officer of Sun Life. Now, what he says is that investors are now going to be looking at equities that seem to be undervalued relative to the bonds. Now, recall that if you're investing in equities right now, you're going to get around 6%, Jess, versus if you're investing in bonds, it's around 2.3%. So you want to be looking at those types of stocks. And he did mention which ones will be staging that recovery. Consumer discretionary, so the ones basically really sold off during the pandemic, real estate, and industrial sectors will be driving 2021's earnings recovery, Jess.
All right, then, but well, things may actually be looking up in terms of equities. An increase in bad loans is threatening the financial sector's recovery. The worst not over yet.
Exactly. So this is, an issue of concern for most analysts that we've been talking to, and this from the Banco Central, bad loans for the bank's highest in 7 years, Jess. So that's the NPL ratio, okay, and that's accelerated for the 10th straight month, and we've hit the highest level since 2013. Now, basically, we rose another 3.6% in October. That's versus 3.5% increase in September, and this is, of course, all of the restructured and past due loans. Now, a survey which was conducted by the Banco Central said that in June, banks are expecting the industry's non-performing loan ratio to more than double. That's going to be around 4.6%. So, 4.6% of all the loans are not being paid back, diba, by the end of this year. Now, another thing, however, that Deputy Gov. Chief Fonashare is saying is that, it's hard to tell which ones talaga yung NPLs, basically because Congress had granted debt moratoriums, diba? So, you've got Bayanihan 2 that's scheduled to expire by the end of the year, basically the end of the month. So that actually gives concessions to people not to pay. So we need to wait hanggang mag-expire yun to really see which ones ba are not really performing. Nevertheless, you've got Security Bank CEO Sanjay Vora. He's saying that this is to the Philippine Star. The NPL ratio of the Philippine banks is still at quite manageable level. So the loan quality remains good. So he said that of course it's going to go up, but the good news is that compared to the financial crisis before, we're still in a better position to weather this pandemic. You've also got BDO President CEO Nestor Tan saying that the NPL level will be likely to peak in the second quarter. Now, finally, I just want to take a quick peek at RCBC because they have seen a prolonged virus hit. So they're seeing the continued asset quality risks here as very challenging for both consumers and businesses in 2021. But in terms of operations, they've done a lot of pivots. So one, no more coal moving forward for the energy sector. So entire banking sector, he says, is moving into the sustainability direction. And they've also boosted their digital capabilities. So for example, unfortunately, Jess, they had to close 66 branches in their network because basically 50 to 60% of the branch transactions had disappeared. But nevertheless, that has been pivoting now towards digital transactions, Jess. Now, I just wanted to move on to your report basically here. So from the financial space and all of these worries, towards the bigger economy here, the ADB has another downward revision to its forecast, and this makes us, the region's laggard when it comes to growth. What's their new projection?
Okay, so this time around, we do know, of course, a slump has always already been factored in pretty much. Everybody's expecting that to happen, not just in the Philippines, but for the rest of the region and the rest of the world for that matter here. But you have this time the ADB further cutting their growth forecast for the country. Previously, back in September, they said that 2020 GDP figures would actually come in at negative 7.3. But this time around, they're saying we are going to expect, or we should at least expect, a contraction of 8.5%. If you try to take a look at that, it's still pretty much within the government's forecast here, the revised forecast at that at 8.5 to 9.5%. And that's on the back of, them saying that household consumption and investment have actually fallen more than they have previously expected. They noted as well that so far that year-to-date slump in GDP of 10% pretty much reflects muted consumer and business activity and confidence. Now, more to the point that you raised there, that also brings us to the bottom of Southeast Asia here. We're trying to take a look at the graphics here that you're seeing on your screen here. Thailand, we are actually the worst in the region, followed by Thailand, which is at negative 7.8%. At the same time, they are projecting, ADB is projecting that Singapore's economy is also going to contract by 6.2%. That's also pretty much the case as well for Malaysia and Indonesia. In fact, the lone player here in Southeast Asia that is expected to grow for 2020 would have to be Vietnam. They are expecting a growth of 2.3% for the country here. At the same time, overall, they are saying that the region's growth is actually going to slump by as much as 4.4%. That also is a downward revision from their previous projection of 3.8%. At the same time, they're also cutting their growth prospects for the entire region to 5.2% from 5.5% previously. However, for the Philippines, they are maintaining their growth rebound forecast, maintaining it at 6.5%, assuming, of course, that public investment picks up and global economy recovers. This, they say, would actually be the second fastest growth in ASEAN come 2021. That is just behind Malaysia's 7%. Now, at the same time, they are saying that their inflation in the country would actually be parked at around 2.5%. That is, of course, an upward revision compared to what they previously forecasted at 2.4%. Year to date, of course, inflation is at 2.5%.
Okay, so worst in ASEAN, at least for this year, and hopefully a sharp recovery and one of the better ones recovering by 2021, Jess. Now we'll have more on the news when Business World Live returns. Just stay with us. You're still watching Business World Live. I'm Danie, Laurel. The government has yet to pick up the infrastructure slack in the month of October, slimming the chances of regaining economic strength in the last quarter of the year. You can see on your screens here, the Philippine Star reports capital outlays declined 21% year-on-year in October to 76.5 billion pesos. Infrastructure spending in the same period also contracted to 57 billion pesos. That's from 82 billion pesos last year. The pandemic has forced delays on various infrastructure projects, but UANP senior economist Sid Rosa pointed to other reasons, such as late disbursements and difficulty in sourcing funds. Regardless, weak infrastructure spending, De Rosa said, could deprive the economy of a reliable economic activity, which could derail its chances of a recovery come 2021. Recall that the government is pinning its hopes on an economic rebound next year between 6.5% to 7.5%. Taxpayers also made use of online means this year with the threat of the pandemic still present. The Finance Department said some 86% or 1.2 trillion pesos of the BIR's 1.4 trillion peso collection from January to September were collected online. The DOF said both the Bureau of Internal Revenue and the Bureau of Customs have implemented digital tools for taxpayers. Digital wallets such as PayMaya were added to accepted electronic payment platforms earlier this year. The BIR also launched pilot operations of its web-based integrated internal revenue system, a centralized database of taxpayer information. The system is targeted for full launch by the end of next year. Tax collections hit 2 trillion pesos in the 10 months of October. Both the BIR and Customs reported double-digit declines in revenues.
Now, despite the continued decline of the country's trade performance in October, NEDA believes there are still positive takeaways from the trade data. Acting Socioeconomic Planning Secretary Carl Kendrick Chua noted that the increase in imports of capital goods in October is a sign that businesses have been responding to the government's targeted and gradual approach to the reopening of the economy. Chua also highlighted double-digit growth in exports to leading regional trading partners like China, 12.7% year-on-year, and the ASEAN at 10.4%. The country's imports fell for the 18th straight month in October by 19.5%, while exports returned to the negative territory with a 2.2% contraction. ING economist Nikki Mapa is expecting anemic exports and free-falling imports to carry into early 2021, as both external and domestic demand are seen to be lackluster at the start of the year. Meanwhile, Union Bank Chief Economist Carlo Asuncion expects a softer decline in imports during the remaining months of the year and exports returning to positive territory. Asian Institute of Management economist John Paulo Rivera said trade recovery will depend on how fast the country's productive capacity could recover from damage caused by recent typhoons. The country's automotive industry has been slowly building momentum with month-on-month increases, but will that be enough to put them to high gear? To talk about their outlook for the sector is Vic Mabutas, a senior consultant for industry solutions consulting at Nomura Research Institute. Good morning, Vic. Nice to have you with us on the show.
Good morning.
Yes, good morning, Jess. Good morning, Danie. Good morning also to the viewers.
Okay, so let's kick things off with the 2020 performance of the industry here. Car sales at least year on year, that dropped 27% in October to just selling around 25,000 units. But that considerably is the highest volume since lockdown started. Year to date, that we're noting a 42% slump here for the industry. How do you see things ending for the automotive sector in the country?
Yeah, well, the automotive sector really hasn't been spared by COVID-19, and the main reason is auto industry involves both the product and service side, and both were not considered as essential industries. So given that, where we see car sales ending at is somewhere around 40 to 46% down. That's year on year. So we expect the market to rally to around 225,000 to 260,000 units for 2020. So for reference, around 416,000 units were sold last year. But as you mentioned, during the third quarter of this year, we really see a resurgence in demand. If we compare the third quarter sales this year, that's around 96,000. That's slightly higher than the sales that we had for the first 6 months of this year, which is around 93,000. So I think we're already on the growth trend for the automotive car sales in the Philippines.
So having said that, how do you see things faring for the industry come 2021? How much of a rebound are we seeing here?
Yeah, so back in July 2020, we mentioned that we're going to experience a U-shaped recovery. And starting from the third quarter this year, we're already on that path. So moving on to 2021, we expect sales to be at around 330,000 to 360,000 units. Still not, reaching the 400,000 unit range. And the main reasons for that would definitely be three factors for NRI. One would be the drag in OFW remittances. Cars still remain an aspirational product that our OFWs would like to have in the future. Then second would also be the drag in household spending. I think it's around minus 9.3% year on year in Q3. So that would create some handicaps in terms of current debt servicing and also the ability of borrowers to take on auto loans in for next year. And then lastly, as Danie mentioned, auto NPL portfolios are also spiking. and that would likely contribute also to higher defaults and also repossessions.
That's actually exactly my next question that I wanted to follow up with, Sir Vic. Now that the Banco Central has lowered the interest rates to a record low and has even released, the triple R reserve ratio, so now there's actually more liquidity. Are consumers starting to tap into these loans, especially for buying non-discretionary or discretionary rather items?
Yeah, I think as the data suggests, there's already that appetite, and it started from Q3, and certainly what the BSP has done in terms of lowering the interest rates, that has helped in terms of the consumption. But if we have to consider, the events that recently happened, such as the typhoon, that would also put some check in terms of what credit items consumers will have moving forward. Maybe they would prioritize reconstruction of their houses first, and other more essential items as
Okay.
compared to auto.
Okay, sir, I just want to move on to the different types of brands. Whether there have been differences when it comes to recovery here. We've always had Toyota having, the best market share traditionally. But now, given the pandemic, do you see that this sort of market, the middle market, will still be the one most resilient? Or are you seeing the luxury segment, for example, more resilient? Has there been any sort of change in the dynamics between the brands?
Okay, yeah. So in terms of how the players are faring so far, we think that the biggest players like Toyota, Mitsubishi, and also and also Nissan, they will likely continue their dominance in the future. But where we see the competition would be is in the middle of the pack, right? So with players like Hyundai, Ford, Suzuki, Honda, Isuzu. Yeah, so these players are converging in terms of the value propositions and also the model lineups that they are offering to the market. So given that, and also the new entrants to the market like MG and also Geely, coming in with their value pack models, it's going to be a very interesting middle of the pack for these players.
Vic, I also would like to ask, what were the key changes that you have noticed in the market since lockdown started here? Especially we're talking about digital adoption here. How fast has the sector managed to make that transition?
Yeah, so in terms of market changes, demand for autos would probably be changed moving forward, and that is mainly driven by the lockdowns, right? So now the market now knows that okay, we can do some of our automotive purchasing, automotive servicing through digital channels, and then second, there's also changes in terms of the workforce arrangements, that makes marketing campaigns and also tracking of KPIs hard or difficult for OEMs and also dealers. So, given these market changes, we have to expect that there would be, some form of digital transformation that would be a response by the Philippine automotive ecosystem moving forward.
Sir Vic, can you compare us with the rest of the region, the rest of ASEAN, when it comes to the recovery of trends in auto? We manufacture, and it's one of our biggest manufacturing plants here. The auto parts, and not just we also assemble our own cars here. Is the decline that was being mentioned by Jess this year just simply because of the lockdowns and manufacturing plants being closed, or is that really a trend that we can see that maybe other countries are just simply becoming more competitive when it comes to their manufacturing?
Okay, yeah. In terms of how we fare against our neighboring countries, I think the Philippines is more similar to Malaysia and also Vietnam in terms of car sales. But I think as a region, the region hasn't been spared with the downturn in sales. I think Indonesia, Philippines, and also Singapore were the most badly hit. And you're right to say that I think there is a relationship between how the lockdowns were imposed in these countries and also the severity of how these lockdowns were imposed. So, the economies which reopened, earlier than us, that would be Thailand, that would be Singapore. Those are probably going to rebound more than the Philippines.
Given that, Vic, how do you think the recent signing of the Regional Comprehensive Economic Partnership is going to affect the performance of the local industry, which so far has also have to battle these car imports? Do you see this to be a boon or a bane for the sector?
Yeah, well, Jess, there's two sides to the RCEP, right? So RCEP was it essentially harmonized the tariff rules and also classifications present in the RCEP member countries. But we also have to remember that the Philippines and also the other member countries already had existing bilateral trade agreements with the members, right? So in terms of the effect on the Philippine automotive industry, there will be a positive impact, positive incremental impact, in the sense that our locally based exporters and manufacturers of parts and also electronic components, they are able now to have that freedom to source raw material suppliers from RCEP countries, therefore, creating more value for them early in the supply chain. So these players, these locally based auto players, parts manufacturer players, can become more competitive in the global market as a result of the RCEP.
Okay, but sir, related to that, you've also got to create bills, probably create law na now, so it's been passed na. But there was a lot of contention on that because of the fact that incentives would not be continuing, let's say, for a longer period. And there was a lot of, issues, especially in the manufacturing industry, saying that you've got other countries like Vietnam or, Thailand having sort of incentives for manufacturing. To what extent will we be feeling the hit?
I think, there would be, we will feel the experience, the impacts of this, but it's more on a rebalance of, the fiscal incentives. So, sure, the industry might take a hit with Create, but it also has some, benefits that it can gain as a result of RCEP, right? So, so at the moment, it's really both a push and a pull factor, considering Create, in conjunction with RCEP.
All right, thank you very much for your time this morning. Still, of course, some good growth prospects here for the industry, at least come 2021. Thank you very much, Vic Mabutas, Senior Consultant over at Nomura Research Institute.
Thank you so much.
And that's a first look into the business day this Friday, December 11, 2020. I'm Jess de Los Santos.
Catch us again Monday next week. That's 9:30 a.m. I'm Danie, Laurel. We are One News.